This week, the Bank of Canada has been hinting that the days of ultra-low interest rates may be nearing an end. Although the central bank left its key rate untouched for a 13th consecutive month, Central Bank Governor Mark Carney caught investors off guard with his more hawkish tone than expected. Joining me now to discuss the Canadian economy is Senior Economist at BMO Capital Markets, Sal Guatieri. Sal, it seems we're seeing a slight turn of the dial to the hawkish side by the Bank of Canada. What are the chances of a rate increase now before the end of the year? And in terms of percentage points, what kind of hike could we be talking about here?
Well, the odds of a Bank Canada rate increase are certainly much higher now following the bank's recent policy meeting than was the case even just a month ago. It appears that the Bank Canada is a little more worried about inflation pressures in Canada, especially with our economy starting to move closer to its capacity limits and expected to do so within the next year. At the same time, the bank is also worried about not just price stability, keeping inflation around 2%, but financial stability. There has been a growing concern expressed by other policymakers, but in particular Bank Canada, about rising household debts in Canada. And it appears that the Bank Canada is becoming concerned enough that it might take action just in response to that risk that households are building up too much debt and therefore posing a problem for the economy down the road. So if that implies the bank may need to move on interest rates a little sooner than it otherwise would like to, that could very well be the case. So we do expect the bank to hold off at least this year, but we think the bank will start raising rates first thing next year in January, and probably raise rates a full percentage point, upwards up to 2% by the end of next year.
For months, the central bank has cited a strong Canadian dollar as dragging on exports and therefore economic growth. What's your short, mid and longer term outlook for the Canadian dollar?
Well, we think the Canadian dollar backdrop is very favorable, not just because we expect commodity prices to remain fairly firm over the next year as the emerging market economies continue to grow at least at a decent rate, but because we think interest rates are likely to stay higher in Canada than in the U.S. and to rise much sooner in Canada than the U.S. So we could see Canadian interest rates much higher than U.S. rates when you look out 1 to 2 years from now, and that will keep a very strong bid for the Canadian dollar. So we think the Canadian dollar will stay above parity over the next few years, likely averaging close to 5 cents stronger than parity relative to the U.S. dollar by this time next year, or certainly 2 years out, when the Fed is just starting to raise interest rates.
Over the past decade, housing prices have almost tripled in some Canadian cities. Do you predict the housing market will slow down and correct itself, or what do you see as being the best approach to avoid an abrupt correction?
Well, we're hoping the housing market does settle down, and we are encouraged by what we are seeing across most of the country. Outside of Toronto and parts of British Columbia, we are seeing housing market sales and prices moderating to the extent that both are growing at a very modest rate now across most of the country. So that's the so-called soft landing that everyone is hoping for Canada's housing market. There's two problem areas. One is parts of BC, in particular Vancouver, where prices seem to be falling right now in an orderly fashion. It's not a hard landing. The bigger concern we're having right now is Toronto, the greater Toronto area, where prices continue to escalate, running at about a 10 to 11% yearly rate for the past couple of months now to March. That's clearly unsustainable, much faster than family incomes are rising, and that does pose a problem for valuations and affordability down the road, certainly when interest rates go back to more normal levels within a couple of years. So I would not rule out some modest correction in prices in the Toronto area. Would not cripple the economy by any means, but it's certainly possible we could see a modest correction in the Toronto area.
To end, Sal, Canada's central bank also raised its growth estimate for this year to 2.4%, and March inflation figures are coming out at the end of the week. At BMO Capital Markets, what are your expectations in terms of growth and inflation for the remainder of the year and into 2013?
Well, for growth, the Bank of Canada is clearly on the optimistic end of consensus expectations. We still think the economy will grow at a 2%, modest 2% rate for this year, and that's one reason we think the Bank of Canada will at least hold off on raising interest rates until early next year, until January next year. If the Bank of Canada's more optimistic growth outlook plays out and the unemployment rate falls more meaningfully, we could see the bank clearly move on interest rates much sooner than early next year. We think, though, that there are enough headwinds for Canada's economy to suggest a more modest profile for growth. Again, about 2%. Number one, a strong Canadian dollar, and it's getting stronger. That's a severe challenge for our exporters and manufacturers. And secondly, in response to elevated household debts, we see Canadian consumers spending at a fairly subdued rate for this year and next year. So those are the two main drivers of our economy. Consumer spending and exports will be in fairly low gear for the next couple of years. And on top of that, we have fiscal austerity, governments cutting back spending over the next couple of years, weighing on the economy.
Thank you very much, Sal. It's lovely speaking to you. Now that's all for the moment, but there are plenty of other interviews to check out on Dukascopy TV, so stay tuned.